That's how you hear people say it. The greatest growth and wealth building tool while they have their sleeves rolled up hitting funny noise buttons on MSNBC. Not that. It's not the stock market. It is the way we participate in it.
Hello and welcome to Your Business, Your Wealth. I am Cory Shepard, president of Sound Financial Group and your co-host on this show. With me today, as always, is a man who is so good at getting a good deal that he even asks for a discount when he pays attention, Mr. Paul Adams. And it is, sorry. This is called breaking. This is, people love it on SNL when you just can't keep going through the bit. You laugh a little bit. Everyone loves it, so we're just going to do it once. So we've been doing a series called Illusions of Investing. And if you're just jumping in, then you don't need to stop and go to the beginning right now. Finish this episode. That's totally fine. But you do want to circle back around and catch the beginning after this, because there's a lot of great material. And it's so there's a lot of technical pieces and a lot of very key points we wanted to get across in a shorter amount of time. So the past several episodes, I've turned it over to Paul to just run through a series of conversations that were really summarizing a series of conversations he and I had when we first met that really that helped me see some things that I had left unhandled for my family and our financial future, and by proxy was very likely not handling with my clients at the firm that I was a part of at the time. So it quickly became a moral imperative for me to not be doing what I was doing and start doing what we're doing now together, but to continue this series as we start to talk about what to do now that you've been exposed to some of these illusions of investing. I'm going to stick around. So Paul's going to carry us through the beginning, but I'm going to be here to talk with Paul about some of the things that we do for our clients and how we start to answer and combat some of these illusions. So Paul, take us off.
Cory, great introduction as always. I miss not being able to do that to you, but I am always excited about what you're going to say about me. And now I know how you felt for the last couple of years every time I introduce you.
And now I know how you felt. It's a lot of fun.
Exactly. So
we're going to be trading off.
Now what we're going to touch on is, what do we do? Now we've been exposed to all these illusions. What it is we think is going on in the marketplace with our money, the way we think financial institutions are marketing us. And now we have some awareness of the illusions. So what do you do now that you're aware? Well, we're going to share with you what we call our passive structured investing at Sound Financial Group. And it really is made up of several factors. One is that markets work, that the market is pricing things properly, and the market tells us things, like communicates information with pricing. Second is modern portfolio theory. Third is the four-factor model. And fourth is the importance of coaching and education around our money. Something that's all too often not talked about is the importance of having a coach, having somebody who educates you in making each financial decision to help the entire financial picture actually be more efficient, not just quote unquote get good rate of return in an investment.
I think people give too much credit to the market for the rates of return, and they don't give enough credit to their own behavior for what that does to the rate of return. Now, usually behavior is not an additional factor; it's a subtractional factor to rate of return, but it's very real. So that one is huge and important, and not just tacked on the end by any means.
Absolutely. So we're going to talk about that first part about markets working. So I'm going to just show kind of a series of pictures for those of you watching online of Nobel laureates and academics. Now, the thing to notice is not that they're all, or mostly all of them are bald, but the thing to notice is that every one of them has a deep academic background, and several of them are Nobel laureates.
Although I don't hate that gray hair, lack of hair. It just it's not the worst thing. But
Absolutely.
The Nobel Prizes are probably more important, yes.
Well, and the idea being that markets do work. Simply said, when somebody releases a new piece of information, the entire market, now I'm going back like 13 years. I was at a business conference, and something I love, this was a non-investment conference. It was just kind of this business philosopher teaching a bunch of us. And he said, a new piece of information is released. And he looked at his watch for 6 seconds and looked up. He says, the market has already repriced based on, that was 13 years ago. Now, between flash traders or the way that people are dealing with their investments, they're trading on E-Trade or they're trading in huge block trades. There's people laying fiber optic cable between the major exchanges to get a little tiny bit of better execution. With all of that, we know that the market is communicating information to us constantly. And what we can't do is get out ahead of it. All those academic studies we looked at earlier in the illusions showed us that even the best of the best, the people making millions of dollars a year of personal income, have no proof that they can consistently or predictably outperform the market. The markets work. So the important thing is to be in the market.
And Paul, my favorite book that covers about every single thing that you just said is Flash Boys by Michael Lewis, who many people know from The Big Short, which became a huge movie talking about the mortgage crisis. And he follows all those pieces, like the company that spent millions, maybe billions, but maybe, billions with a B, getting a straighter line for a fiber optic cord to just take, I don't know, hundredths of a second off the travel time between Chicago and New York for their trading information. To get that much faster was worth it to them. So as an individual investor, if we think we're going to read something in a magazine, I mean, just the time it took to print whatever we're going to read, that's already in the market, let alone by the time we read it.
Yeah, even if it's on their website and you're the first person to read it, by the time you could execute a transaction, the market has already adjusted because it was public to somebody else before the magazine published it. So then when we do participate in the market, how should we? Well, we're going to use modern portfolio theory. Now, for those of you that don't know, modern portfolio theory came to vogue back in the 1950s and ultimately won Dr. Harry Markowitz a Nobel Prize in economics. See, prior to this, you didn't have a way to reduce your risk other than just owning more bonds. So you owned your basket of stocks that were picked, and then you owned your bonds. And it was the blend between those two were the only way to diminish risk. What Dr. Harry Markowitz did is he showed that different asset classes do not move in lockstep. As a result of them moving up and down differently, we can actually reduce risk by combining them in a portfolio. Now, winning the Nobel Prize in economics is not as easy as you might think. Not that you were thinking it's easy, but two things had to happen. One, it needed to work in reality in the marketplace. It started back in the 1950s, but then he had to also live long enough because they do not give the Nobel Prize posthumously. So he still had to be around for it, and it needed to have worked. So developed in the 1950s, awarded in the 1990s, it's a big deal. It was awarded as a result of changing the way people invest. And that's where we own this broad, highly diversified portfolio, helping reduce risk. For those of you watching, we just have a simple graph of investment A and investment B moving up and down at different times, giving you the less volatile center line, which is the combination of the performance of investment A and investment B. What also came out in modern portfolio theory is that there is a maximum amount of risk to take in a portfolio. It's called the efficient frontier. The efficient frontier is this horizon on a graph that allows you to understand that, oh, if I'm going to take this much risk, then this should be my anticipated return. Now, for those of you watching online, I want to call your attention to something. You'll see the S&P 500 on this graph below the efficient frontier, meaning we're taking more risk, more volatility than we are getting in reward over time. What that means for us as an investor, if we're not on the efficient frontier, we're taking some amount of uncompensated risk. It's not terrible.
I like to think about it like if someone's unhappy with how much they're getting paid in their job. Like you're like, if anyone out there that's listening has ever said, they're not paying me enough for all the work I'm doing, all the responsibility that I have, like that's what this efficient frontier is. Are you getting paid enough for the kind of risk that you're taking in your portfolio? And under the line means you are under compensated.
That's it. And so you're taking additional volatility without getting the reward. Now, this, like we mentioned a few moments ago, developed in the 1950s, tried and tested through the 1990s, 1990 Nobel Prize in Economics, awarded to Dr. Harry Markowitz, but study after study after study has been done since. And one of the biggest studies was the determinants of portfolio performance. Well, here's what they discovered. 91.5% of a portfolio's performance is dependent upon the allocation you choose and the discipline by which you rebalance. Market timing is 1.8%, other factors not yet able to be identified 2.1%, and 4.6% was stock selection. Now, you should be asking this, Paul, in one of the prior illusions, you just finished saying that market timing and stock picking don't work. Correct. These are determinants of portfolio performance. It does not mean those are positive contributions to performance. That when you engage in market timing and stock picking, we don't have any academic evidence that those are going to work out well in the long run. They might work out well for a person bragging at the cocktail party. You could be listening right now. Maybe you're the person it's worked out for and you're bragging at the cocktail party, dragging other people into a pit that you happen to have avoided and it didn't swallow you alive. Too much,
And
Cory?
Of course, if you I think we can't be strong worded enough about this because it's where we differentiate ourselves and where we separate from so much of what's in the financial current. And but the 1.8% on market timing, this is not, universal for every condition, every person. This is over a long period of time. And what I mean is, if say in 2008 you took your money completely out of the market for the next 10 years, well, now that's responsible for detracting 100% of your rate of return.
Yes.
So don't be lulled into like, oh, well, let me try a bunch of market timing and at worst it's going to be about 2% down. I'm like, no. You can make these worse if you want to.
This is determinants of portfolio performance over a large group of people. Don't be part of the people that create the tails of the bell curve.
Right.
In fact, I've lived my whole life just hoping to not prove the exception to the rule.
Right.
Because the exceptions to the rule do prove the rule. Let's take one more look at what happens when you build a portfolio. So you're saying, Paul and Cory, so you're saying we need to be compensated properly for our risk, etc. Well, we're going to give you an easy example. Let's say all we did was we own the Standard & Poor's 500 index. And we can look and see that the rate of return we'd expect from 1970 through the end of 2017 would be 10.5%. And the standard deviation, that's those risk units, how much risk are we taking, how volatile is the investment, is 16.99. So we'll just call that risk units going forward. If we add to the portfolio 25% in a European index, now our annual gross return drops very, very little. So now we're at 10.32, standard deviation of 16.79. And then if we also added an international small cap fund, we now end up at 10.88% and 16.99 in risk. Simply said, that we can take the same amount of risk and produce additional return by properly choosing our asset allocation. More on that in a minute. Cory, I'm ready to go to the 4-factor model. You ready?
Let's do it. Yep.
So when investing, there's only 4 areas that have been proven to consistently and predictably produce additional returns and be worth the cost to execute. So there are strategies that can be used by an individual stock picker or in a fund, and they point to all these results of it being wonderful, like trading on momentum. The trouble is, if trading on momentum is the only strategy, the costs of trading on momentum, the additional tax costs, the additional trading costs, all of that wipes out the actual additional return when studied, not when just told as a unique sort of story that lulls an investor into investing.
And this was so huge for me when we first talked about this, and we're at some of the research conferences about this, that they've studied factors that are real but not profitable in a practical setting. So real in an academic research sense, but not profitable. So momentum being one of them, meaning you can actually lose by winning. Like you can implement some of these things, see some positive movement in your portfolio, but not actually have been better off. In fact, maybe worse.
So well said.
Wow.
So these four factors are A, the market, a big shocker for everybody. The market, stocks, outperform bonds over time. Second is the size factor. Small companies outperform large companies. Most people accept that, no problem. Third is the value factor. Those companies that have a better price to book ratio, meaning like they own stuff, or maybe for reasons outside of the company's financials, etc., its stock price is lower compared to its book value. And last but not least is more profitable companies over time tend to outperform less profitable companies.
Shocker.
And the thing that should really shock you is not that profitable companies outperform less profitable companies, but the fact that that also, as a part of Eugene Fama's price markets theory in 2013, won him the Nobel Prize in economics. In part because profitability is one of the things that can drive returns for a portfolio without taking any more risk. We'll come to that in a moment. But when we talk about taking that risk, we've given you a few different looks at it, but I just have you think of it this way. When you step up to a golf tee, if you're golfing and you hit it with a driver, you're taking more risk than if you use your 7-iron. But what you're hoping to do is hit the ball further than you would have if hitting it with the 7-iron. Now, for me, I take a lot of risk when I use a driver. It's going to go through somebody's window, into a yard, hit a tree, and come back at me. I could lose yardage, frankly, using a driver. But I use it when appropriate because I want the additional return of the extra distance. But if you took the same golf club and you just climbed to a high point on the golf course, picture a nice green up on a rise, during a lightning storm and then held the driver over your head, did you take much more risk? Yes. Is there a positively correlated outcome that you're going to like from taking all that extra risk? No. That's what we see when many people just tie blindly, more risk equals more return. No, it does not. Lots of risk is uncompensated risk. You hold that golf club over your head during a lightning storm, you are not likely to be compensated. In fact, there's zero likelihood you're going to be compensated for that risk. So we're going to talk about each of these tilts, each of these factors, and how you get compensated for having a portfolio that takes advantage of these four factors. With that, Cory, what do you think about taking us to a quick commercial break right before we come back and hit those four factors?
I think that's a great idea. So we've covered everything from lightning to male pattern baldness. It's really hard to tell where we're going to go from here, but it is going to be highly valuable in the world of investing. So when we come back from a quick message from Sound Financial Group.
Hey everybody, I had to interrupt our show for just a moment to share with you something new. We've designed a new white paper that we think is going to add you value in the way that you think about money. It's 3 of the biggest mistakes we see people make and 6 ways to fix them. Now, for some of you, you might not want the white paper. You might be ready to have a conversation with us, and that is okay. You can email us at info@sfgwa.com. That's info@sfgwa.com. Find us on the web at yourbusinessyourwealth.com. And anytime on any of our social media platforms, send us a message and we can get you this white paper. But in the meanwhile, if you want to just skip over the white paper, have a philosophy conversation with us, we're happy to do that with you. Just let us know philosophy conversation in the subject line. And if you want this white paper, just put white paper in there and we'll immediately get out to you this white paper on the 3 biggest mistakes that we see people make and the 6 things that you can do to fix them. And now, back to our show. Welcome back. So we're going to start covering each of these 4 factors. These are the factors that are proven over time to produce additional return, compensating us for the extra volatility we're taking on. So the first one, not a mystery to anybody, is that the Standard & Poor's 500, ever since 1926, has outperformed bonds. Now I'm going to call something to your attention though. The S&P 500's return since 1926, 9.71. The standard deviation, easiest way to understand it, is that most of the time, like 65% of the time, that slope that you're hoping to get, in this case 9.7, is in some years going to be higher, like plus 19%. So that would be like 28%. But it could also be the other way, negative 10. That would be a totally normal outcome. So how much does it go above and below that 9% growth line over time? And 95% of the time, it should be within 2 standard deviations. Don't let that worry you now. Just think about it as, here's our risk units. So it's a lot more volatility and risk than treasury bills, but the return is like 300% higher almost, meaning treasury bills over that period of time did 3.35, while S&P 500 did 9.71. That's the first factor. Second factor is that small companies tend to outperform large companies. Now you can see that it's 9.71% versus 11.86%. Now the biggest misnomer people have is they look and go, well, that's a 2% difference. What's the big deal? Well, the difference is not 2%. Cory, do you want to tell them how big the difference is?
So it's about, let me say 20%?
Yeah,
something like that.
Little more than 20%, because if you think about it, if you had $1,000 growing, it's either going to grow by $97 or it's going to grow by $11.80 or $118.
There we
that
go.
$118 is 20% larger than the 9.7. See, we don't edit out our mistakes. We just let you guys hang with us while we do them.
That's right.
Now, is there more risk? Absolutely. See that additional volatility, but we are getting a lot more return over time. Now, each of these factors do not manifest every single year, but they do manifest more than half of the time through the years, enough that it gives us that extra little return. Next is value. That value stocks those that have a better current price to their book value as a company. And this is another one, 9.7% versus 12.4%. Now, is there additional volatility? Yes.
Oh, sorry. Speaking of factors that haven't that don't show up every single year, anyone who's been following the markets will know that value hasn't been showing up lately.
Yep. Now, here's the funny thing. Value has been performing just below its long-term average. But compared with growth the last 4 years, growth has been, for some reason, outperforming its long-term average. There's some theories about that we're not going to get into today. But what is likely to happen is some point in the future, there's going to be a reversion to the mean, meaning growth will have to level back out to be more like its long-term average, while value is performing slightly below its long-term average. So even though we haven't seen those returns manifest on an annual basis for about the last 4 years, growth has been outperforming value. That has happened ever since the 1920s, that each of these factors will have periods of time that they're out of favor. But what we've watched happen just in the latter half of this year is that the value premium is starting to come back, and it's coming back quickly. Mm-hmm. So we've got some white papers on that. If you guys have questions, feel free to reach out. We can go deeper down that particular rabbit hole. Last is the one that we laugh about, we say tongue-in-cheek, but did win somebody a Nobel Prize, which is profitability. More profitable
during
companies.
The tech bubble, this was a shocker to a lot of people for some reason. You know, if you remember pets.com, it was like all you needed was a good idea and an even better domain name. And that was enough to be a good company to invest in.
Yes.
And so profitability does win out in the end.
Or even just think about what people might say is, well, look at all the years that Amazon wasn't profitable and look, it's a behemoth now. Yes. But what's not told in that story, remember all the way back to survivorship bias, how many companies were trying to be Amazon who ended up with a market capitalization of 0 when it was all done, or bought by some other company for pennies on the dollar? What we need to be able to do is just realize that we're not investing for a big win today. We're trying to build a portfolio that will allow our wealth to grow on our balance sheet on a consistent, ongoing, and predictable basis over long horizons of time so that we can reach definite financial independence with enough capital to fund our work optional lifestyle. So profitability is the fourth factor. The thing I'd call your attention to if you're watching this right now is it does it with less risk. So the more profitable companies outperform by about 1%, but do so with less volatility than the regular large cap growth stocks. Okay. That's our 4 factors. So let's get on to coaching and education. Now, we alluded to this a little bit earlier. There is the importance of being able to hold strategy. We're not only talking about that. We're talking about all the little things that a coach working with you and your money should be able to identify. Can you do a backdoor Roth IRA? Are you financing your mortgages as efficiently as you can? Does your will and trust actually demonstrate the actions that you want your money to be in after you're no longer there to direct them personally? All of these little inefficiencies with our money make an enormous difference. Coaching and education does too. Why is this important? Well, I'm going to give you guys just a little bit of math if you're listening, and then if you're watching, you're going to see this graphic. But I want you to picture, let's say every single year, you spent 2 hours planning from ages 25 to 65, 2 hours every year planning out your retirement. Now, we already know that most people spend more time planning their family vacation than they do planning their money. And to date, I've yet to meet the person that spends 2 hours every single year since age 25 planning their money. But let's say we did do that. That would be a total of 80 hours. The trouble is if you live from 65 to age 95 for you and your spouse, that means you're going to be depending on this money for 262,800 hours.
Wow.
So just think about this for a moment. Does that seem like an appropriate amount of work in to product out? Of course not. We have to spend more time thinking about our money, being in conversations about our money, reading books that deal with money, because if we don't, we're going to be in a spot where we've looked forward in the future where we only invested 80 hours into it or less, and we're going to anticipate that it should produce our long-term financial income for many, many, many times the amount of hours that we put in. Here's another way to look at it. This big graph, huge pie chart, demonstrates your time in retirement. And for those of you watching online, there's this little tiny sliver.
I think there is a line there. I'm pretty sure.
Is. I built this graph, and literally PowerPoint laughed at me. It's like, you didn't really mean to put 0.07, but 80 hours is only 0.07% of the total amount, 262,000 hours that your money's going to have to be producing those outcomes for you in the future. That is a huge deal. That's 30 years our money might have to support us. We will likely spend more time living off of our capital at work than we spent accumulating all of it, earning for our entire career. This is why that literally a little tiny, the thinnest line I could make it represented on a graph of how much time we're likely to spend in retirement. You've got to make sure we have the coaching and education. And now, when we work with clients, and what we recommend all of our clients do is get as many of your advisors to be okay with working with you in a virtual environment as possible, because you don't know where your wealth is going to take you. So What do we do for education? Well, we meet with our clients online. We take time where they and their spouse can be in an office somewhere and meet with us. They could be in 2 separate offices working with us. You could bring your CPA in to that meeting and meet with an advisor. You might have an opportunity to see us live at an event, or you could be sitting in your pajamas somewhere meeting with us. That's not a picture of Cory in his pajamas meeting with you, but it is.
I do have a green screen, so I can't guarantee it's not a T-shirt that's got a picture of a dress shirt over it. Just saying. But I have one other thing to admit, Paul, and we didn't talk about this, but we've got lots of great clients, and we've got some longtime clients that there are years where they don't return my calls enough to have spent 2 hours that year on their money. And that's not a problem. I mean, we might want to solve it, and we love you. It's, we know life gets crazy, but that's why we've created this podcast and this show. Because you driving around, you might get a chance to listen to some of these things and add on to that, even if we can't always be walking with you every single step of the way, although we're going to keep trying.
Yeah. And well said. And for those of you that are, kind of considering, maybe you're building up a career somewhere and you're kind of been thinking to yourself that once we get out, exercise all my stock options, I'm going to move to another part of the country. Or you might be somebody who owns a business right now and you're kind of planning your exit in 5 or 10 years. I want you to imagine how important making sure your advisors are virtual is. You have an exit. You now have more money on your balance sheet than you've ever had before. And you move to the proverbial Arizona, Palm Springs, the Nevada side of Tahoe, wherever you're going. And now you're going to start up fresh and you're going to try to find some big box financial retail advisor in a town you've not been living in for the last 20 years and hope that the first choice with more money you've ever had is going to be the right choice. Just build and develop a strategy with an advisor that has the ability to meet you wherever you are. We are one of those advisors, and there's some others out there. I would encourage you to make sure for that reason, so that the coaching is accessible to you, that you build a team that is virtual or has the ability to be so. Now, why is that so important? So speaking of the importance of having a coach, on screen right now, I've got up this beautiful gym. It's just gorgeous, built in somebody's basement in a slamming mansion, and they've got every piece of equipment you could imagine. It is gorgeous. Or there's Bob Harper with a medicine ball. Now, what do you think is likely to push you to better outcomes with your fitness? Having a really cool room of a gym to be able to work with, or minimal amounts of equipment, but a coach? Think of it like golfing. Is it the clubs, the best possible clubs, or is it working with a coach to make sure you're swinging those clubs as efficiently and as effectively as possible? Well, we all know it's going to come down to the coach. Now, I'm not saying that we're amazing. We're pretty dang good. But the importance is the ability to access the coaching to create the environment where you have a chance to reflect on the action you have taken and the outcomes you want to have with your money, so that you're co-designing with somebody else that future that you're creating, not just having a bunch of equipment in a room, looks like you probably use it, looks like you're probably squared away, except you're not getting the results. So let's jump on to the academic approach when it comes to investing, and then we're going to land this plane. So what do we pull together? Well, we know that free markets work. We know about the 4-factor model. We talked about modern portfolio theory, and we talked about client education and coaching. Where those 4 overlap, picture those 4 as a Venn diagram. Where they overlap is where Sound Financial Group's passive structured investing model comes in. So I'm going to give you an example of what it would look like to just build a portfolio only with indexes, diminishing the risk, increasing the amount of return we might be able to get over time. This is going to seem a little heady as we talk through this when you're on podcast only. So you might want to go back and watch the end of this one on YouTube. But don't give up on us yet, because you're still going to get some nuggets. So why do people typically end up with such low returns? We know that over time, individual investors tend to perform much lower than institutions. And the reason is they break strategy. That's where they freak out at some point, say, I just need to sell it. or
This
they
is
go
the
chase
moving
returns.
everything into cash in 2008
Yes.
and missing the return and the recovery.
Yeah, moving into cash. And when most people moved to cash was at the bottom. Most people did not move to cash in 2008 when it was still good. And even those people didn't get back in time. Or they'll chase returns. Who's that asset manager? What are they doing? Well, let's go invest with them now. They'll try on stock picking, or they'll just be timing the market as we talked about earlier. So let's just start with a portfolio. Our first portfolio construction is 100% Standard & Poor's 500. We talked about this earlier through 2000. And by the way, this is some people's portfolio.
This is what many people think is the market, like a diversified portfolio. Yeah.
Now, the Standard & Poor's 500 is 500 stocks, all based in the U.S., mostly large cap growth stocks, okay? Now, the annualized return of that portfolio in 1970 through 2017 is 10.53, with standard deviation, that's the risk units, of 16.99. So let's start by adding, this is going to sound kind of funny, actually adding 40% bonds. 40% bonds. Like we had a 100% stock-based portfolio. We're adding 40% in bonds. That's got to kill our return. Nope. Rebalanced annually, 9.24%.
So we went down in rate of return by 10%-ish, but kind of like 40% less
reduction.
Risk.
Yes, yeah. Reduction in the volatility, reduction in the risk. So now let's try portfolio 3. So you can see on the screen, we're just adding different chunks. Now we're going to add a European index that's largely large cap and a small cap European index. Now we have a total of 30% international, and our rate of return goes up a little, and our risk barely increases. So now we're at 9.81 in return and 11.02 in risk. Remember, we started at 10.5 and almost 17% in standard deviation at the beginning of this. In portfolio 4, we just add U.S. small cap value and U.S. large cap value. And what you see is we end up at 10.68% in return with less risk of only 11.48. So we just produced
my favorite thing. This is so great. Paul, sorry, let you land that point. So this is the efficient frontier that we were talking about earlier. If you hear that old axiom of more risk, more return, it's not always true. And the time it's not true is when you're not already on the efficient frontier. If you're below that efficient frontier, we can actually get more rate of return for less risk just by making the portfolio more efficient.
And this is only, yeah, perfect. And this is only looking at the portfolio itself. So Jordan, we can scrap the screen and now just be on me and Cory. Here's what I want you guys to be able to leave with, is that those illusions are real. But what people think when we've talked through all these illusions is they've seen the negative outcomes. They've seen stock picking not work. Then they tried it with an asset manager. Then they tried it with their own E-Trade account, and it didn't work either. They tried market timing, and it didn't work. They tried each of these things, and none of them worked. And what do people often say? Well, that stock market is rigged. I'm just not going into it.
No. Or even worse, someone's been invested in just the S&P 500 this whole time. They have held strategy, and they think it's working.
Yes. And for you listening now, you might be one of those people who has had some of those wrong turns in the market, but it's not been because it's your fault. It's not because the market doesn't work. In fact, I think all told, the most accessible and dependable wealth building tool to all of Americans is an academically allocated, globally diversified portfolio, not the stock market. That's how you hear people say it. The greatest growth and wealth building tool while they have their sleeves rolled up, hitting funny noise buttons on MSNBC. Not that. It's not the stock market. It is the way we participate in it. And by being aware of all these illusions, then looking at an existing portfolio and comparing it to what it would look like if it was academically allocated and globally diversified. We just gave you a bit of an example with indexes, But what we end up doing when we manage money is we use a set of tools that allow us to have our clients in over 13,000 different positions in 42 different countries who are transacting in 190 plus countries.
Ooh.
It's all meant to be enormously diversified for the sake of achieving market returns. We don't use the tilting to quote unquote beat the market or crush the market. The tilting a little more toward the market, tilting a little more toward value, tilting a little more toward small cap, and tilting a little more toward profitable companies is meant to give us an extra 1 to 1.5% rate of return, allowing you to have an advisor with you through that journey and overcome that frictional loss that comes with getting advice and getting coaching. So our goal with our clients is just to achieve market returns. Now that takes away a whole bunch of sexy marketing slogans of, oh, our asset managers have a really good story and we went on this due diligence trip to the Ritz-Carlton or whatever it was. We don't do any of that because we know what works. Here's the key. If you're listening to this now and you've not done so yet, I just want to encourage you. Take the time, like for lack of a better way of saying it, be brave enough to realize that either you have enough confidence in your current strategy that it can withstand a second opinion, or confronted with the statement I just made, you realize maybe it can't withstand a second opinion. You can start getting that second opinion by being in communication with us. We'll share our philosophy with you. Well, if appropriate, we'll do an analysis of your investments for you to give you a sense of how they are doing when compared to being academically allocated and globally diversified. It's nothing major. It's nothing fancy. We don't even sell our clients on this philosophy. Rather, we tell the story, and then people say, well, what about this? And we're able to present the facts to them. Well, what if we did this other thing? And then we're able to show the facts. And in that scientific type of environment, we give you the opportunity to learn, to challenge some of this, and work it out for yourself so that you can own the way that you invest in the market. You can understand how it works, which then gives you the freedom to not have to worry and the ability to continue to question it, not as questioning somebody's opinion, but question it like, does it still work? And that's what we're constantly doing, is questioning, and does it still work? Does it still serve our clients? What is happening now and what should we do next? Because one of the most important things that should happen is that your investment should be creating the future you want, not just a return in the current year. Cory, anything else you want to leave with folks as a parting thought?
No, I don't think so. Well, just what you said, Paul, that we don't have the way. We just have the best way we've found in our research, and we're always looking for more. And that's what we think everybody should be doing. That's why we've done this series, to help you start that journey for yourself.
Right on. And as always, we encourage you to reach out to us, give us a review here on the podcast. Just make sure it's honest. Send us a screenshot of it. We'll send you a copy of our latest book. We'll send you a copy of Cory's Cape Not Required. Or I think we still have a few copies left of Michael Michalowicz's Clockwork. Want to encourage you to make that review. Send us a screenshot to info@sfgwa.com. And we hope that this episode has been a contribution to you being able to design and build a good life. Hey everyone, hope you enjoyed watching that video, tuning in. We love having you guys here. Don't forget to like that video, subscribe, and hit the alert bell. But by the way, if you just have questions and you want to dig in and learn a little more, go ahead and email us at info@sfgwa.com. Put yourself in the position to have a 15-minute phone call. I mean, come on. Can your current plans withstand a second opinion? If not, that might be the very reason to reach out.